There's one fact that most people don't realize. Part of your investment portfolio may have been built on Japanese money, not because Japan invested directly in you, but because for more than 3 decades, the global financial system has relied on borrowing money from Japan at almost no cost. Hedge funds, banks, and financial institutions borrowed Japanese yen at near zero interest rates, then used that money to buy U.S. Treasury bonds, tech stocks, real estate, and even Bitcoin. It became a financial engine that injected trillions of dollars of liquidity into markets around the world. But now, that engine is starting to reverse. The Japanese yen has fallen to its weakest level in nearly 40 years. Government bond yields are climbing, and the Bank of Japan is facing an almost impossible choice: save the currency or save the economy. If Japan begins pulling its capital back home, the consequences won't stop in Tokyo. U.S. interest rates could move even higher. Global stock markets could lose one of their biggest sources of cheap capital, and every asset that benefited from decades of easy Japanese money may soon face its biggest stress test. The most unsettling part is that process may have already begun. Today, we'll explore how a country that spent 3 decades trapped in economic stagnation could become one of the biggest forces shaping the future of the global financial system. In economics, there's one rule that almost never fails. The more a country borrows, the more interest it has to pay. That's how financial markets price risk. When governments accumulate too much debt, investors demand higher yields to compensate for the possibility of default. That's exactly what happened to Greece. It's also what happened to Argentina and many other heavily indebted economies. But Japan became the exception. Today, Japan's public debt exceeds 200% of GDP, the highest among developed nations. According to almost every economics textbook, an economy carrying that much debt should have collapsed years ago. Yet it didn't. The reason comes down to one thing: interest rates. After its massive real estate and stock market bubble burst in the early 1990s, Japan entered nearly 3 decades of deflation. Prices barely moved, wages barely grew. Consumers stopped spending. To keep the economy alive, the Bank of Japan pushed interest rates to almost zero and kept them there for decades. Borrowing money in Japan became almost free. And when borrowing costs are close to zero, even an enormous amount of debt becomes surprisingly manageable. But that's only half the story. Unlike countries that suffered debt crises, most of Japan's government debt wasn't owned by foreign investors. It was owned by the Bank of Japan, Japanese banks, insurance companies, and pension funds. In other words, Japan was borrowing mostly from itself. That unique structure allowed the country to survive for more than 30 years without triggering a full-scale debt crisis. But those near-zero interest rates also created something far bigger than anyone expected: a financial engine that quietly pumped trillions of dollars into the rest of the world. Near-zero interest rates didn't just save Japan. They also created one of the largest investment strategies in modern financial history. It's known as the yen carry trade. The idea is surprisingly simple. Imagine being able to borrow money at almost zero interest. Meanwhile, another country is offering 4 or even 5% returns just by holding government bonds or other financial assets. What would you do? That's exactly what hedge funds, banks, and institutional investors around the world did. They borrowed Japanese yen at almost no cost, then converted those yen into US dollars or other currencies to buy higher-yielding assets. That included US Treasury bonds, stocks like Apple, Nvidia, and Microsoft, real estate, even Bitcoin and other risk assets. The difference between borrowing costs and investment returns became almost like free money. Over the past 3 decades, this strategy helped move trillions of dollars out of Japan and into global financial markets. It also turned Japan into one of America's largest creditors. Japanese pension funds, insurance companies, and banks accumulated enormous amounts of U.S. government debt. In other words, every time the United States borrowed more money, there was a good chance that some of the financing came from Japan. And every time U.S. markets reached new highs, part of the capital behind that rally could be traced back to borrowed Japanese yen. But this entire system depended on one critical assumption: Japan's interest rates had to stay near zero forever. The moment that assumption changed, the entire machine would begin running in reverse. Then came 2020. The COVID-19 pandemic disrupted global supply chains. Governments injected trillions of dollars into their economies. Energy and commodity prices surged, and after nearly 3 decades of almost no inflation, Japan finally experienced inflation again. At first, the inflation rate didn't look particularly alarming, But for a country that had lived with almost flat prices for 30 years, it was a major psychological shift. Suddenly, the Bank of Japan faced an impossible decision: raise interest rates to fight inflation and risk making its massive government debt far more expensive, or keep rates near zero and watch the yen continue to weaken. That's exactly what happened. While the United States pushed interest rates above 5%, Japan kept its rates close to zero. Investors immediately sold yen in favor of US dollars. The Japanese currency fell to its weakest level in nearly 40 years. For Japan, this was especially painful. The country imports most of its energy and many of its raw materials. Those imports are priced in US dollars, so every time the yen loses value, oil becomes more expensive. Production costs rise. Consumer prices increase. Inflation becomes even harder to control. A vicious cycle begins. A weaker yen creates more inflation. More inflation increases pressure to raise interest rates. But higher interest rates make Japan's enormous debt burden even more dangerous. For the first time in decades, Japan found itself trapped between two painful choices: protect the currency or protect the bond market. And unlike the past 30 years, there was no longer a way to keep everything exactly the way it was. So what happens if Japan can no longer keep interest rates near zero? The answer can be summed up in two words: capital repatriation. In simple terms, it means Japanese investors begin bringing their money home. The logic is straightforward. If Japanese government bonds now offer attractive yields again, why would pension funds or insurance companies continue taking exchange rate risk by investing overseas? They can simply sell US Treasuries, sell foreign stocks, convert those dollars back into yen, and invest at home instead. That may sound harmless, but remember, Japan has been one of America's largest foreign creditors for decades. If one of your biggest buyers suddenly stops buying or even starts selling, you need to find someone else. And the easiest way to attract new buyers is to offer higher interest rates. That means borrowing costs across the United States could remain elevated. Mortgage rates, business loans, consumer credit, all of them could become more expensive. There's another consequence. For decades, cheap Japanese money has helped support risk assets around the world. If that source of capital slowly disappears, global liquidity begins to shrink. And when liquidity dries up, the assets that benefited the most from easy money are often the first to feel the pressure. That doesn't necessarily mean a financial crisis is inevitable, but it does signal something important. One of the world's largest sources of cheap capital may finally be coming to an end. For more than 30 years, Japan was seen as an economy frozen in time. Low growth, low inflation, near zero interest rates. Many assumed it no longer had much influence over the global economy. Ironically, that very stability became the foundation for one of the largest pools of cheap capital the world has ever known. Today, that foundation is beginning to shift. The transition could take years, or it could simply create periods of heightened volatility. No one knows for certain. But one thing is becoming increasingly clear: if Japanese capital truly begins returning home, the global financial system may have to learn how to operate without one of its biggest sources of cheap money. And that could become one of the defining economic stories of the coming decade.